Going through the mortgage process can be stressful. With all the different deadlines, countless emails, and so many things going on, it'd be nice to have an idea of what's to come. This video will hopefully help you with that. If you're preparing to buy a house for the first time, you can make the process easy on yourself by learning as much as you can ahead of time before you found that dream home. Knowing what to expect allows you to plan ahead and improve your chances of knowing exactly what goes on during the mortgage process. What to Expect is a series where I go over the main concepts of obtaining a mortgage, broken down into 3 sections. What you need to know before applying for a mortgage, what you need to know during the mortgage process, and what you need to know for after the closing. The goal of this series is to help you become more comfortable with the most commonly asked questions, as well as general information to get you more in tune with what the expectations are. If you haven't yet, I would suggest going back and watching the first of the series, What to Expect Before the Mortgage Process, before watching this video. In this, the second section, What You Need to Know During the Mortgage Process, we'll examine what you can expect when it comes to the timing, stages, and what will be required of you, your loan officer, and all of those involved. Here are the important aspects of what you need to know during the mortgage process to ensure that when the time comes, your start to finish process will go as smooth as possible. When we think of the major stages during the mortgage process, we can break it down like this: the prequalification, the preapproval, home shopping and purchase offer, which will include document requests, your loan estimates, loan processing, disclosures, appraisal, and title. And then we have the loan decision, which will include the final credit check and the final approval, and finally closing. So let's start by diving into the prequalification. Prequalification, time frame, hours to 2 business days typically. Today's process has changed when trying to buy a home. With shows on HGTV glorifying the home shopping process, it sometimes and somewhat disregards the first step in the whole process, knowing what you'd actually be pre-approved for. Getting a pre-approval before you start shopping for a home can help when you're ready to make an offer, because then you'll actually know if you could offer on that home. Some places might not even let you see it without proof of being pre-approved. The mortgage process truly starts with a pre-qualification, though you could skip this step if you choose to go straight through to the pre-approval. The pre-qualification is when you do an unofficial pre-approval by talking through any previous home ownership, your income, your assets, your debt, and the goals for the home purchase in order to get an overall sense of whether you would qualify for this loan. This conversation can happen over the phone, virtually, or in person. This process is typically very fast and convenient, and you should have an answer within a day or two, or at the very least, a game plan of what the next steps could be. During this conversation, the lender is also looking to see if there are any red flags that would then allow us, a loan officer, to know whether or not you're ready to buy. If, for example, you had a recent foreclosure, you'll need to wait several years before you can apply for a new mortgage. If there are no obvious red flags, you'd then move on to the pre-approval, where you'd apply, they'd pull credit, and you'd back all that information you provided in the application with documentation. Pre-approval. Time frame, 1 to 5 business days typically. The pre-approval can often take longer than a pre-qualification because it requires application and documentation. At this point, you can also discuss how much you plan to put down and the types of mortgages that may fit your situation. These could be fixed or adjustable rate mortgages, conventional or government-issued programs such as a VA, an FHA, or a USDA loan, and what type of product you could fit into, such as a first-time homebuyer loan. You're not tied to these options at this point, but you'll know exactly what your options could be to get pre-approved. Initially, you may be asked to provide the following documentation: 2 months of bank statements. Now, be sure to include all pages, even those that say intentionally left blank. You also want to include your proof of your income for the last 2 years, So this could mean your W-2s or 1099s for self-employed borrowers, or even 2 years worth of taxes. And then finally, your most recent pay stubs. Once all of your information is collected, the lender will update your file and use an automated underwriting system to independently verify your income, assets, and debt to the chosen mortgage program, rate, and term. Think of this as a computerized underwriter based on what's in the loan file. Those findings are forwarded to an underwriter once it's been assigned to your file, who then compares them to the information you've provided. The underwriter's job is to determine the risk involved in giving you the loan, but none of that will really happen until you have a signed and executed purchase agreement on a home. If your initial information checks out, the lender will then generally provide a pre-approval letter indicating you may qualify for a home loan. It is generally discussed that you would qualify for a home loan up to a certain amount, and this process can often take 2 to 3 days if the information you supplied is complete and accurate. Now, depending on your file and the complexity of it, it is sometimes common to ask for additional or more current information. The process might then take a little longer. I personally issue a pre-approval to you and your real estate agent, and then I do a property-specific pre-approval letter so that each list agent knows I specifically looked at the specific property that you're setting forward an offer on. Now, this pre-approval letter is specific for the property and separate from the pre-approval letter I state that just lets everyone know that you're pre-approved. Now remember though, a pre-approval letter is not a guarantee that you'll get the loan. You still have to go through the actual underwriting process. Getting pre-approved has its advantages. It shows your agent and the sellers that you're serious about buying and that the lender already feels you're financially capable of it. Plus, in today's environment, without a pre-approval, the chances of a list agent accepting your offer is actually quite low. Some list agents may even require a pre-approval letter just to see the house. Now, you may ask yourself, how long is this pre-approval letter good for? Really, however long you need it. So credit reports last for 120 days, so you need to close within that time frame. But if not, it's not a problem. Just new credit will simply need to be repulled again, and this typically isn't done unless there's something potentially worrying about your file, such as a lower credit score. Now, you would simply just stay in contact with your lender, giving them updates on anything substantial that has changed with your credit, your income, and all that. And the lender may ask for updated pay stubs or bank statements over time as well, just to stay current. Once you've been pre-approved, it's a good time to get lined up with a realtor if you haven't yet. You might also be wondering, how much does a realtor cost you? As a buyer, it doesn't cost you anything. The seller's net proceeds actually pay for the list and buying agents. Like mortgage lenders, not all real estate agents are created equal, so make sure that you do your due diligence when picking one. Your mortgage loan officer will have some recommendations for you for a realtor if you're unsure of where to go with that. Document requests. Time frame varies and can happen concurrently with other steps. Throughout the loan process, the lender probably will request additional or more current documents. I mentioned this already. So, for example, it's not uncommon for lenders to ask for updated bank statements and income information such as pay stubs. Now, this might be frustrating when you're anxious to know whether your loan is approved, but try to be patient. And remember, it's to your advantage to reply promptly. You want to respond to these requests ideally right away and within about 48 hours. This keeps the process moving. In a perfect world, you did a lot of work up front with your loan officer in that pre-approval stage, so things should not be exactly anxiety producing at this point. An in-depth pre-approval allows you to worry about what colors you're going to be putting on the walls with your paint, rather than whether you're pre-approved or approved for the mortgage. Home shopping and purchase offer. Time frame varies widely depending on your real estate market. Finding the right home for you could happen in a matter of days or can take a couple months. Whatever your situation, when you've found the home you want to buy, you work with a real estate agent to structure a purchase offer. Your offer includes what you'd like to pay, inspections that need to take place, like a home inspection or termite inspection, contingencies, like financing contingency that gives you time to get a loan or to sell your current home first, and how much you'll put down in earnest money. Typically, you'll pay earnest money to an escrow company when you submit your offer. Now, it's often 1 to 2% of the sales price, and if you pull out for any reason that's not allowed under the purchase contract, you could lose that money. Now, don't confuse earnest money with your down payment, which your down payment is the amount of money lenders require you to put towards the home purchase. And this will depend and can vary based on what program you're in. The down payment is typically between 3 and 20% of the purchase price, depending on the loan, and is due at closing along with your other closing costs and prepaid items, also known as your taxes and insurance. Your earnest money will generally be kept in escrow account and be applied towards the purchase price at closing. Earnest money is sometimes viewed by the seller as how interested you are in a property in addition to what you offer. Your loan estimates. As you look for homes, along with a pre-approval letter, you will also typically get an updated estimate for the property you're looking at to offer on. This process not only allows the lender to double check the home is within your pre-approval limits, but also gives you an idea of what your payments will look like for the property. Once you have an offer accepted, typically within 3 days after your loan application is complete with the new home address, a more official loan estimate that outlines the terms of your loan, including the estimated closing costs, the interest rate, and the monthly payments, which include principal, interest, taxes, and homeowners insurance, will be provided. As I mentioned before, you should have already received unofficial estimates prior to this, so you would already kind of have a general idea of what your payments are looking like and the closing costs that you'll have. This is included in your disclosures, which we will talk about in a little bit. It's important to know that the loan estimate doesn't mean your loan is approved, and it still needs to go through the official underwriting process and be officially reviewed by an underwriter. During this stage, you'll probably also have the result of your home inspections and maybe negotiating with the seller with the help of your realtor to make some repairs if needed. Loan processing. Time varies based on your closing date. You've been sending your lender a lot of paperwork, and you may be wondering where it's all going and what's going on with your loan. The loan processing can take much longer than most borrowers would like, but it pays to be patient. Most likely your file is in the hands of a mortgage loan processor for the processing portion of the loan mortgage process. It's their job to ensure that all documents are present and accurate, clarify any discrepancies, and ask for additional information as needed. Because time is elapsing, you may need to send in new pay stubs or bank statements so the underwriting can consider them current on your current date, as some documents expire and updated ones are needed. I keep stressing this because that is kind of how the process goes, especially if you have a longer lock. When your loan file is complete and upfront after you have the purchase agreement and have sent in all of your documentation asked of you, it is then sent by the processor to an underwriter who will verify your identification, credit, and make sure to assess your financial situation, which includes verifying your income, cash reserves, equity investments, financial assets, and more. If you'd like more information on the underwriting process, check out some of my other videos, and the one that I'm specifically referring to should be shown up above. Disclosures. During the mortgage process, once you have a signed purchase agreement, you can also expect a series of disclosures to be sent your way for review and for your signature. Typically, you'll use an e-signature technology on your phone, tablet, computer to view, download, sign, upload, and return these documents. Typically, it's a very streamlined process at this point. While it isn't required, e-signing documents condenses what used to sometimes take days into just minutes. But to use this technology, you'll need to sign a consent form stating that you agree to the process. Most lenders include this consent form as part of their online application process from the very beginning. Appraisal. Now, in reality, the appraisal can provide anxiety for all parties involved. After a purchase agreement is accepted and the inspection contingencies have been lifted, an appraisal will be ordered. Now, this is needed to determine if the amount that you've offered to pay for the property is appropriate based on the home's condition and the comparable homes in the neighborhood. If the home appraises at the sales price, everyone's happy. Obviously, if it appraises above the sales price, the buyers are happy, but the sellers won't know. If it does come in too low, this is usually when the realtors get involved again to discuss and negotiate how to handle the low appraisal. The seller may need to lower the price to the appraised value to keep the deal moving forward, or the buyers may have to pay the difference. The lender also has the option to dispute the appraisal, though in all honesty, this usually isn't very successful. Title. After the purchase agreement is sent over to your lender is also when title will be ordered. A title search makes sure that the property can legally be transferred. A title company will check for any claims, liens, easement rights, zoning ordinances, pending legal action, unpaid taxes, and restricted covenants. If the property is clear of all these prohibited encumbrances, the title company issues an insurance policy that guarantees the accuracy of its research. Often, two policies are issued, one to protect the lender and one to protect the buyer. Now, the one that protects the buyer is called the owner's title policy. So the owner's title insurance is generally optional and is not required, but in the unique scenario where you would need it, your owner's policy will pay for itself many times over. I personally would highly suggest getting it. Loan decision. Time, about 3 days to 2 weeks if all the information you supplied is still current. Now is the part of the loan where the processor has submitted your file and it's time for a human underwriter to look it over and make sure the documentation provided fits all of the guidelines in which your loan was set up under. Many lenders adhere to underwriting guidelines from the government-sponsored enterprises Fannie Mae and Freddie Mac, which purchase mortgages in the secondary mortgage market. In most cases, Fannie Mae and Freddie Mac guidelines require a maximum loan-to-value ratio of 97%, or in other words, a minimum of 3% down, a credit score of 700 or higher, and a debt-to-income ratio of about 45% or lower. But, like most things in mortgage, each of these is dependent on your unique scenario and program. The underwriter will generally make one of three decisions about your loan. They'll either approve it, they'll conditionally approve it, or they'll deny it. The most typical decision is the conditional approval, which simply means the underwriter will approve the loan if certain conditions are met. The underwriter may have a question or a few that must be cleared up before they can approve your loan. These can include things in and out of your control. Now, you might need to explain where money from your bank account came from if it wasn't from a regular paycheck, or maybe pull a document that's aged during the review time, like a bank statement that shows your current balance. Or maybe you need to get a signed gift letter to prove that you don't have to pay back that gift fund that your parents gave you. Out of your control items would be things like waiting on an appraisal to be completed or verified, and to get in title verification documentation. Once these items are satisfied, your loan will be approved. Now, it's not very often when a loan can get to this point and be denied, but it is possible. There are some reasons a loan application could be denied. For example, if your employment status or credit situation has changed since after you applied, those are two of the more common causes for denial. Again, if you'd like a more in-depth look into the underwriting process, check out my video on it. Final credit check. When the lender pulls your credit at the very beginning of your loan application, that credit pull is good for 120 days. This simply means you would need to close your home within that time frame, or a new credit report pull would be required. It is important to remember that roughly 10 days before closing, a soft pull of your credit report, kind of like a Credit Karma does, will be performed to make sure that no new debts have been taken out and your revolving debt payments like credit cards haven't really changed that much. In other words, don't make any large purchases that could raise your debt to income ratio or lower your credit score once you've applied for a mortgage. Final approval. When these activities and all other required actions or inspections are complete, the underwriter gives the final approval. This is where you hear the truly magical words in the real estate and mortgage world that everyone wants to hear. You are clear to close. Learning you're clear to close is cause for celebration because it truly means that you're going to close and get that house. Once the closing has been cleared, a closing agent from your lender's company and the title company will review instructions and requirements from all the parties involved and the legal and loan documents. They will then assemble the charges, prepare the closing statements, and schedule the close. This is where you get the dialed in numbers so you know exactly what to bring to closing. Closing. Now that you're clear to close, you'll probably have to e-sign a few more disclosures indicating the more dialed in numbers, since the title closer and the lender's closer have been working your loan numbers down to the very penny. This process is called balancing. After this is when you would actually go to the closing, where you'll wet sign documents and get the keys to your house. When you get to a closing, the seller and the buyer can sign documents at different times or together. In any case, the seller signs the deed and the closing affidavit, and the buyer signs the new note and the mortgage and any other disclosures. The seller's old loan is then paid off, and the seller, the real estate agents, attorneys, and all other parties involved are paid at this time. This is also when the realtor and lender usually both come to see you off to sign your papers. Personally, as a lender, this is a super fun time because sometimes this is the only time I get to see a client in person. I personally like to take a photo with my clients and the realtor if they come to celebrate that moment. And then at this point, you are officially a homeowner and you can go and move into your house. So I hope this gave a good breakdown of what to expect during the mortgage process. This obviously was quite generic in nature and your experience will be somewhat different, but being prepared for what's to come will help alleviate any anxiety you might feel towards the process. There's a lot to know and a lot does go on, but with the right loan officer and the proper preparation, you'll be able to get through it with ease. Now, if you haven't watched, please watch my previous video on what to expect before the mortgage process, or check out the next video in the series, what to expect after the mortgage process.